a two-part question. One is dilution. So a lot of founders, when I speak to them, especially in Pakistan, you've been in Silicon Valley, it's a long 30-year history. Most people that have worked in the industry understand dilution. The expectation is that they're expecting to own the majority of the company even when they exit. What are your thoughts on that? What should the mindset be? And should it be more focused on building a company and realizing a vision that you have cohesively, or should people actually play defense on their equity?
Never been a fan of dilution. I'll be perfectly honest. Why? I mean, and maybe it's a controversial school of thought, but ultimately, if you know that you're going to build a company over the longer term, right? And I say that I've been repetitive in this, but I want to make sure the message gets through. Some of the founders, when the company went public, it was worth several billion. They only had a couple of percent. Yep. And they were fine with that. They were totally fine with that. Okay. So I actually think it's the wrong way to think about, and it may be controversial. Maybe it's the wrong way to start thinking about it because you just don't have the proof points. Right. So what do you ask yourself a fundamental question? What do I need to build a successful company? Right. And in order to do that, if you basically have a high quality investor, right, like Faisal Aftab, I mean, let's not hold back here, sir. I mean, you're an investor that people are going to come to not just for investment, but it is value add. You've got the data points. You've been able to see a history of founders, good, bad, and ugly, and you're able to basically provide intellectual input that basically that is valuable to them. That's worth basically having on the board. That's worth having on the cap table, right? So I think, and by the way, data from last year shows it. So some interesting points. $320 billion was invested in startups last year. That's in the US alone. About 60 billion was invested outside the US. 220 billion was raised last year. So by the way, for anyone who's trying to figure out building company, this is a great year. We've just signed our 6th term sheet. People are actively investing. There's a lot of dry powder out there. And VCs, it's our job to be able to deploy capital. The point I'm basically making is, you've got to think about dilution in a way which basically says, what do I need from a value add perspective to do that? There's a bunch of companies that raised money last year at very inflated valuations. And I'll tell you right now, a lot of those founders they were thinking about dilution first. They were thinking about the company last. So here's what happened. They basically raised at a probably 90x to 100x multiple of what their existing revenue was. And they raised only a small amount on that valuation, so they didn't get overly diluted and they didn't give up equity. Well, in order to grow into that valuation, now you've got to hire all these people. You've got to basically spend all this money, get all the marketing in place so you can grow into that valuation, right? Well, congratulations. Unfortunately, with that thought process, which is short-term thinking, you have an economic downturn. Now your customers are not basically renewing or not buying as much. The salespeople are trying to basically figure out where they basically go. They start leaving. You've started doing layoffs. And now you're running out of cash. And so now you're basically doing another fundraise to be able to recapitalize the company, and you're doing it at round. So if you think about dilution from that vantage point, it doesn't make common sense. By the way, with the utmost respect, and maybe this may be self-serving, you're coming to venture capital firms for investment. We have a job to do to be able to raise funds and, actually give returns to our investors. So as much as it may sound a little bit, problematic when somebody says, I want 15% or 20% or 25%, that's a negotiation that you need to have. Here's how you negotiate that. You talk about what you need and how you think about the company. Maybe it's the option pool that you want to have for the rest of the employees and the hires that you're typically making. Think about how you're able to value the company. If, having 50 or 60% of something is better than having 100% of absolutely nothing. Right? If you walk away because you said, well, they were asking for too much, that's in unreasonable times, that's totally fair. But then you've just stopped yourself from building a company and taking your project to the next level, which you basically had. And sometimes those hard decisions are typically made. The best sort of funding, customer revenue, no question, right? And when you don't have that, you need to basically have investment. And guess what? unfortunately, venture capital firms have to basically think about returns just like everybody else, just like you do. So that's how I would basically, I would not start with thinking about dilution. I would think about company building and how you basically do that.